Hey, Scott, welcome. Thanks for being here. Appreciate it.
Of course, Tom.
All right.
How are you?
Good. I'm doing good. But we've got API data after the close today, pushed back one day due to the holiday on Monday. And then we've got EAI tomorrow. Now, we've seen some choppy numbers here recently where we've had distillates and gasoline inventories really exploding while oil inventories have been pulled down a little bit. What are your expectations going into tonight and tomorrow's inventory data?
Honestly, my expectations is that the estimates that are out there right now are probably not going to be close to what the actual numbers are. We've seen that probably over the last, I'll say 6 months, but certainly the last 3 to 4 months, that these estimates haven't meant a lot. It sure seems to me that regardless of what comes out here, I believe there's still going to be pressure in the oil space. Even with the news out of Venezuela today, we couldn't get that to rally back, really. We came off the lows of the day, but we couldn't get that to push, numbers higher here. So I think we're going to see some excess inventory. Maybe we'll see a draw, but again, I think those numbers are going to be quite different than what's expected.
Scott, spot on in terms of your projection there. We used to joke back in the day and say that these EIA numbers were random price generators, but let's talk a little bit about some of the impact or lack thereof, I should say, that some of these reports. Tom and I were just talking about the IMF this week. Last week it seemed like it was EIA, IEA, all kind of pointing towards, well, what should be somewhat bearish crude, but yet it's managed to hold on to the 53 level, basically found comfort right around 53 this week. Do you think that's because traders are sort of looking at OPEC as ultimately kind of the safety net right now? I mean, they mentioned 1.2 million last month. It sounded like they started to cut early, and they seem pretty adamant about continuing to cut and keeping those levels up.
Yeah, I do think that is the one tailwind that can at least keep levels where they're at here. Otherwise, I think we'd be back sub 50 again here. But I think that's what traders really are looking at. But, again, there's so much on a day-to-day basis, so much geopolitics that plays into not just the whole macro market, but the energy space as well.
Yeah. I kind of agree with Scott here on this. The whole oil situation is production going to meet demand? Is demand going to continue to fall until we get a lot of these trade skirmishes taken care of? That might not happen. And I think it's going to be a volatile market, just like the equity market, until we get some sort of resolution. But we are seeing that correlation now. Ben and Scott, let's pivot over to Treasuries. Earlier this morning, stocks were way up. We had treasuries down, yields popping on that news. A complete risk-on day. And that was quickly reversed mid-morning. Ben, your take on that, the risk-off or this fall in treasuries where we're actually getting a little bit of a bump in yield, but not definitely off of highs for those yields. Your thoughts moving forward with that correlation, or are we going to see a return to safety where they come in and start buying up these treasuries?
Yeah, it's really interesting because I just took a look. While we are seeing some very closely tied inverse correlation in terms of what you'd expect to see treasuries versus the indices. So as the indices rally, treasuries come off a little bit. That's been present on the intraday. But Tom, if we look at the bigger picture, you've got the Dow, which is pulled all the way. It's rallied back to middle of December levels, but yet the treasuries, the bonds have only pulled back to levels that they were seeing still at the end of December. I mean, basically what this is pointing to me is this is telling me that, while stocks are rallying back and there is some optimism associated with trade, there's still a lot of concern out there, or at least in terms of rates and the fact that it's not expected that they're going to raise them in the near future.
Yeah, that is a concern, and we do have that Fed meeting next week. But Scott, I wanted to get your take on this. It was reported that China came out and basically pushed back and said, hey, we're not going to stop buying U.S. treasuries, which should help support the bond market here in the U.S. But looking forward to that Fed meeting next week and looking forward to trade talk with China. Is this safety play where you're getting the best yield here domestically? Is that going to be the theme moving forward as far as the Treasury market goes? Because we all know that everybody expects the Treasury market to fall, and there's a big buildup in short interest there. But does that mean it's not going to happen because everybody's hoping that it happens?
You know, I'm usually one of the naysayers. I'm usually on the opposite side, and I don't mean to be a bandwagoner on this one here, but man, if the writing's not on the wall for what's going on with the Treasury market, at least over the next couple of weeks through the Fed meeting here, you know, I don't know what is. You know, fool me once, it's your fault. Fool me twice, it's my fault. You know, I just don't see how yields are going to be getting back even above 280, 285, let alone 3% anytime in the near future here. And
Yeah.
obviously, I'm talking about the 10-year.
Yeah, the 10-year. And, you know, that's a concern because now expectations have been pushed out by the market in general that the Fed might not do anything until June. And when June comes along, if this trend of slowing growth takes place, that they actually might cut. So, you know, it's still up in the air at this point, but we're going to have to wait and see on that and see if we can get some trade resolution, maybe to kind of, you know, put a little bit of sense of stability in this Treasury market. I'd like to thank Scott Bauer, CEO of Prosper Trading Academy, for joining us. Thanks again, Scott.
Thanks, Tom.
All right.